Thank you all for joining us this afternoon. Happy New Year. We hope you all enjoyed the holiday season and have started 2024 in a positive manner. Myself and my partners, Erin Peabody and Don Ledoux, will be walking through our quarterly town hall presentation today. We will spend about 30 minutes walking through the slides, and then we'll save some time for Q&A at the end of our presentation. If you have a question for us, please don't hesitate to write it in the Q&A box on your Zoom bar. The overriding theme of this quarter's presentation is cooking shows and kitchen references. Now, the cooks on these cooking shows have to be well prepared, they have to have done their homework, and they have to have a plan. The reality is, on these cooking shows, the challenges they have and often the ingredients they are given are a surprise. Similar to us as financial planners. We are prepared, we have a plan, but we have to also be prepared for surprises and challenges along the way. Here are the themes we're going to talk through today. The U.S. economy, monetary policy, fixed income markets, the U.S. equity markets, which we're calling the Gordon Ramsay equity market, because with current valuations, there's very little room for error. We're also going to talk through a potential uptick in volatility as we progress through 2024. Our first theme, the U.S. economy. We have nicknamed the U.S. economy the rotisserie economy because from our view, there are parts of the economy that have rotated from hot to cold over the last few years. For example, if you look over the last 2 years, there are areas of the economy that have been doing really well. Think air travel spending, up 194% over 2 years. Leisure and hospitality, up 41% over the last 2 years. These are the things associated with the services we have been spending our money on. However, we do think the incredible growth you've seen here is going to start to roll over as we progress through 2024 because consumers have less savings, student loans now have to be paid, and credit card balances are currently stretched. Now, there are also areas that haven't been doing as well over the last 2 years. Think existing home sales. They're down 44% over the last 2 years. Manufacturing has been in contraction for 14 consecutive months. We do think we are close to seeing the bottom in these areas, particularly if interest rates come down. The growth in these areas could offset some of the weakness we're likely to see coming from the consumer. This rotation in the different sectors of the economy is a reason we don't see a major recession unfolding this year. Now, the consumer is the biggest part of the economy. It represents 70% of GDP. And when we look at real-time indicators, the consumer is starting to show signs of fatigue. Starting to see employment market slowing. Services are softening. Hotel occupancy is at a seasonal 3-year low. Restaurant performance is near the lowest level in 3 years. The high-end consumer is also cooling. Look at luxury watch prices. They're at the lowest level in 2 years. Architecture billing, which shows us the construction that is going to happen, is at its lowest level since 2001. This is suggesting that the consumer is fatigued and we're starting to roll over. Now, on top of the consumer slowing, if you haven't already heard, we're also in an election year. And contrary to popular belief, recessions can occur in an election year. In fact, 3 of the last 13 recessions have actually occurred in an election year. Now, Raymond James economists believe we're going to see a mild recession in 2024. Their belief is that we have a potential contraction of GDP growth from peak to trough of less than 0.5%. Now, given the very small contraction, they are closer to thinking we will navigate a soft landing than thinking we will see a larger recession. In fact, these same economists are thinking it could be the mildest recession in history. Now, why so mild? First, we don't see major economic shocks. We don't see over-leverage. We don't see a relapse of the COVID shutdown. And when we look at job losses, we think we will have them, but we don't think we will see substantial job losses. The job market has been very strong, and businesses have had to work hard to attract their talent. We believe since those businesses have worked so hard to find their talent, they aren't going to be quick to let them go. And then government spending. There will be positive government spending from the acts that have already been passed. That money just hasn't been spent yet. Productivity is increasing through AI, automation. This will help alleviate some pressures of a slowing economy. And lastly, we had a big rally last year, and household net worth is at a record high. When people feel wealthy, they tend to spend. When you add that up, we're thinking we could have a mild recession that may last in the second and third quarter, but still see positive GDP growth for 2024. Our second theme, the Fed. Now turning to the Fed and Master Chef Jerome Powell, Powell will have a big say on the outcome of the economy this year. In December, it appeared that the Fed ended its tightening cycle and that the next move will more than likely be a rate cut. Now, why did the Fed switch their stance? Remember, the Fed has two mandates. Mandate number one is stable prices or managing inflation. Mandate number two is a robust economy, and this is viewed from the lens of full employment. When it comes to inflation, it feels like the Fed is nearing its task of getting inflation in line. Now, the Fed needs to keep their second mandate in mind. Inflation peaked in 2022 at around 9%, and currently it's around 3%. This is a large reason why the Fed has pivoted of late from higher for longer to potential rate cuts in 2024. When you look at goods pricing, prices have come down dramatically. Things we buy have seen declines, which is helping inflation come down. Now, services are more mixed. We've seen some declines there. One component that is staying sticky is shelter or rent prices. Shelter costs remain elevated. There's an expectation that during 2024, the rental component of CPI could come down, and that could keep inflation trending downward. That's a positive. Now, the second mandate of the Fed is the economy, and the Fed is hearing that the economy is slowing. When you look at employment data, you see that. The labor market is easing. Job growth may even turn negative mid-2024. Now, if we do head into a recession, some economists are thinking we could see 1 million job losses. Now, this is light compared to other recessions. The historical average is 3.5 million jobs lost during a recession. Again, very light. We're expecting that the Fed could potentially cut rates 3 to 4 times in 2024, starting around mid-year. There's other economists out there that are thinking there could be 6 rate cuts. We really only envision that happening if the economy is weaker than we are expecting. Fixed income is the third theme of this presentation. The fixed income market is like a show called Bar Rescue. And on this show, the show goes into different places and helps turn them around. Now, when we look at fixed income, it's had a rough 3 years. With recent increases in interest rates, bonds are once again attractive. In this chart, in every sector of the bond market, yields have risen from the lows of COVID. The new starting point of bond investments have higher interest payments, which means they have higher return potential. In the bond market, the recent rise in interest rates gives the bond market a cushion to absorb if rates do go higher. If you look at what happened in the lows of COVID, then if rates would have gone up by 1%, you would have seen bonds lose 9%. But now that rates have risen, there's a bigger buffer because you're receiving the higher coupon payments. Now, if rates rise to 1%, the loss on bonds would be about 3.7%. There's lower downside risk, so bonds now have a more favorable risk to reward profile given the recent rise in interest rates. I'll now turn it over to Aaron, who's going to walk through the equity markets for us.
Thank you, Vanessa. So we're going to jump into equities here, and as Vanessa mentioned earlier, the critical eye of Gordon Ramsay. So let's take a look at a couple of charts here. So as we look at equities, there's reasons to have some discernment and to keep our eyes on some of the math behind the equations. If we look at earnings over the last 2 years, earnings were relatively flat. Now, consensus earnings on the S&P 500 right now are coming in around $245 earnings per share. Now, if we take that times a multiple of around 21, that would get us to a target S&P 500 value at 48.50, which is effectively where we're trading right now. Now, if we look at history as a lens for us to look through, we need to understand that oftentimes consensus estimates start the year actually at their high point, and as the year continues, optimism starts to wear off, and generally the earnings per share start to pull back. If you remember back to some of our previous presentations, with these flat earnings that we've experienced over the last couple of years, we really need markets to pick up. In order for markets to pick up, we really need earnings to pick up. Because as you guys can see here in this middle graph, our valuations are at the upper end of historical ranges, meaning people are fairly optimistic coming out of 2023. Improvements in things like artificial intelligence have increased folks' confidence, so people are willing to pay more for the earnings potential of these companies, but we do need to see earnings profitability rise in order for our markets to continue to grind higher from here. It's also really important to remember that pullbacks are normal, and each time we see markets fluctuate up and down, even a 5% pullback is not fun, and we experienced that last summer. If you think about what happened in the S&P 500 over the 2023 year, we had a nice start to the year, then summertime hit, and we had a 10% pullback between summertime and late October. Nobody was feeling very good. Everyone was feeling like we're maybe in one of these recessions. Those are normal pullbacks. Those 5% pullbacks tend to happen 3 to 4 times per year. We are, though, as Vanessa mentioned, forecasting a very mild recession. Though with limited increases in revenues, the good news is we do expect margins to continue to be stable, as we've seen a lot of cost cutting happening already in 2022 and 2023. Remember, we're coming off of some of the lows in COVID, where the earnings and the margins had really disproportionate movements in the overall markets. Now, as we go off to the next slide, some reasons for optimism. So the S&P 500 has rallied in every election year dating back to 1956, with an annualized average rate of return of about 13%. We have to remember, though, in those years, we do tend to have pretty significant volatility. Again, it tends to have some volatility early in election years, and then as we get closer to the actual election, volatility tends to pick up. But again, we've experienced an average 13% rate of return. While the markets have continued to grow, some folks have made comments recently that the markets are coming off of recent highs. We had a really great run in 2023 with the S&P 500 being up over 25%. Now, maybe that means that the market's gotten ahead of itself. Now, again, if we look back at history, coming off of markets where the markets run more than 25% the year prior, 70% of the time, the next year is also positive. The markets tend to grow on itself with an average return of, again, of 12%. So very likely that we see a lot of volatility, given a lot of the movements and things that the market's trying to digest right now. But if history is any precursor for us, again, the markets should grind higher going through 2024. Now, as we start to talk about what sectors of the markets we're most excited about, we'll start to dive into section 5, which is these equity sectors, new ideas. What are those richer flavors that we're really looking for? Now, there's 3 that are most interesting for us right now. Information technology, AI, which had an unbelievable run there in 2023, the healthcare sector, and then industrials. So let's walk through kind of the rationale for the excitement between those 3 sectors. Let's start with artificial intelligence. I love this graph here on the right side. This looks at the adoption rate of some of the historically significant technology that we've experienced here in the United States. So you'll see there we've got generative AI, we've got mobile, internet usage, and PCs. And if we just look at the slope of those graphs, We get some early adoption, and then we get some just more modest growth as we start to experience and people start to utilize these various new technologies. But if we look at that line there in generative AI, that line is almost running straight vertically, right up and down, where we're at around 50 million users of AI today. And in the not too distant future, before 2030, we're expected to be north of 400 million users. So 8 times the application of what's going on today. And what's really exciting about AI is it impacts so many different sectors of our economy. It's not just helping technology per se. This AI is really impacting just about every sector of the economy. And we're still in the very early stages. So 2023 was really around the building of AI. So a lot of the technology, the companies that did well, the NVIDIAs and AMDs of the world, the chip manufacturers that are driving the productivity of that AI. If we think about, though, AI in the context of the internet, the real money that was made in the internet wasn't necessarily coming from the internet, but rather the companies that figured out how to use the internet to drive commerce, right? If you think about a Facebook or you think about a Netflix, those weren't necessarily internet companies, but they used the technology of the internet to grow what had historically been slower growing businesses into rapidly growing businesses with major upside. The other thing that's really exciting about the AI space, IT space, is that the margins in those businesses are still very healthy. With new technology, people are willing to pay a premium for those types of services. So some of the more just normal blue chip type companies that have been around a long time and are still growing, those margins tend to be tighter, less profitability driven by each dollar of new revenue. If you just look at the margin growth within this AI sector, it's significant, and that margin really is going to help that earnings per share that we were looking at earlier, that we really need to drive higher so that the markets can continue to propel forward to new heights. Now, as we look at, again, at some of those tailwinds coming out of 2023, the information technology sector was up 56% last year. And so the question becomes, have we already seen the run? Is it too late? Is that opportunity past us? And we would say no. If you take a look back, 2023 was an incredible year for tech. 2023 was a good year for the markets. But we have to remember we were coming off of a really terrible 2022. And if we look back at where we started in 2022 to where we are here in 2023, 23 was really just making up for 2022. And we still have what we consider to be pretty significant upside. If we look at the graph here on the left, again, that's looking at the earnings growth of the AI sector. We talked about the S&P 500 as a whole being relatively flat between 2022, 2023, AI earnings growth at 8%. Even though, again, if you look at the AI sector as a whole coming from 2022 through the end of 2023, haven't seen huge improvements in stock prices. Again, last year was a really great year, but that was coming off of a really rough 2022. If you also look at the performance of the NASDAQ versus the S&P 500, it's actually coming off a historically low drag compared to the S&P 500, meaning that there's more upside potential still to go in these technology companies. And if innovation continues to happen, that adoption rate goes from 50 million users up to 400 million users, that will drive profitability and allow those companies to continue to grow, even though they are coming off of great years. Now, as we look at our next theme, healthcare, we talked about IT coming off a great year in 2022 or 2023. Healthcare was kind of the opposite. It was a pretty flat year overall in the healthcare sector. But we still look back at the overall demographics in this country. People are living longer. Average life expectancy is now 79. And as we've definitely had advancements in medicine to help us live longer, not always with greater quality of life, the healthcare sector, though, is going to benefit from this longevity of life and people needing more and more services. We've seen major advancements in drug development, things like obesity, cancer, Alzheimer's drugs, And again, with people living longer, the expectation is that there are going to be more and more need for a lot of that care. The other thing that's really interesting about the healthcare sector is that although we think it's a sector that's got a lot of upside potential, it also tends to be a very defensive sector, meaning if the economy tends to slow down, healthcare is not an area where people can necessarily just cut back. You know, if the economy slows down, we have to make the decisions. Do we go on vacation? Do we not go on vacation? Things like picking up prescription drugs, surgeries, those types of things are not things that we can necessarily push off. So we think that it's got some nice upside to that part of the sector, while at the same time being a defensive sector to help if we do see some volatility in the overall markets. Last sector that we're going to talk about is one of the favorites is the industrial sector. And Vanessa touched on this really briefly earlier. We've seen some huge government spending through things like the CHIPS Act and the Inflation Reduction Act. With some of the wars, unfortunately, that are going on overseas, concerns about things like China and Taiwan, there's been a big push to try to bring back to the United States, or some of the countries that are close to the United States, some of our key components in things like semiconductor and pharmaceuticals. So driving that increase in semiconductor and pharmaceutical production, all this spending coming from the government through the CHIPS Act and the Inflation Reduction Act should really benefit the industrial sector. We've seen some of those dollars start to be spent, but really the bulk of those dollars have still not yet been spent. So we'll start to see some of those dollars flowing into the industrial sector in 2024 moving forward. We're also coming off of a manufacturing low here over the last 14 months when we look at the ISM index. And historically, when we've hit a low point in the ISM index, we've seen a 30% historical appreciation from the industrial sector coming off of that ISM low. So we expect to be around that ISM low right now. Again, as long as we're in that ballpark, in that area, could be some nice opportunity there in the industrial sector. Again, continuing with our themes of kind of dive bars, we're going to dive into small cap equities here. And if you've been listening to a lot of these town halls over the last couple of years, we've been big proponents of not necessarily small cap, but rather large cap US. That's where a lot of the profitability, that's where a lot of the innovation has happened. As we've had some volatility in the markets, small cap has really underperformed the large cap sector. If you look back here over the last 7 years, large cap has outperformed small cap by about 75%. So almost 10% per year over the last 7 years. So that in and of itself does not look overly exciting. But if we look at the graph there on the left and we look at the valuation metrics, if we look at where small cap stocks are trading today relative to their historical averages, we can see that the valuation metrics are really, really low right now in small cap. And if the Fed can effectuate this soft landing, if we can stay out of a significant recession and only have a mild recession, when profitability does start to pick up again, that should really help drive the small cap sector and drive some of those valuations higher, just back to averages, historical averages, create some nice upside for some of the small cap sector. Now, that's not necessarily a part of the market that you just want to buy broadly. We really are looking for active managers that are diving deep into the weeds, because small cap companies are smaller companies, so they can be more susceptible to revenue variability, interest rate movements, things of that sort. So it's really important to have a keen eye when looking at the small cap space. But as a whole, we think there's some opportunity there where we haven't been huge proponents of that sector really over the last 7 to 10 years or so. Last slide that we're going to look at here in the small cap sector is really looking at the overall market cap of those companies. And what's really interesting, if you take the Russell 2000, which is all the small cap, the 2,000 smallest companies, their market cap is actually lower than Apple by itself. So again, we just need to see some inflows, some confidence in that sector, and that creates some really significant upside opportunity for the space. So I'll kick it over to Don to touch on international equities.
Thank you very much. Appreciate it, Aaron. Thank you, and hello, everybody. So I'm going to touch on international equities, and on the next slide there, it will show a chart, and on that chart, it gives the U.S. a grade A performance. The U.S., you can see, has outperformed the developed markets, mainly throughout Europe is what's being shown here. And there's a couple reasons for that. We have touched on that in the past. And the primary reason is that if you go back over the past 10 years, as we were coming out of the Great Recession, all the economies were trying to find ways to invigorate their economy and get their economies going again after primarily the big housing bust in the US that had financial repercussions around the world. Well, the US was able to continue to spend its way out of its problem, and we all learned about some of the finer rules about Europe and the European Union, and more specifically the Euro, when it was introduced in 1999, had a couple of very important rules around it because, for example, Germany has a history of being very financially prudent, and some other Southern European countries less so. And they said, if we're going to jump into a currency together, we're going to have some rules, much like running a budget at a house. And so the rules were you could not have more than 60% debt to GDP issued, and your debt could not grow by more than 3% a year. Well, those rules tightened the ability for most of Europe to spend recklessly, I'll call it, unlike the US, where the dollar monetizes the world and still does, in spite of the news we hear about people or countries moving away from using the dollar. The US was able to continue to issue an ungodly amount of debt, and to this day does so, and that has kept the US economy going forward. As an example, in 2018, the US had about $21 trillion of debt, and here we are 5 years later at about $34 trillion of debt, so up more than 50% in the past 5 years, where Europe has far more restraints on that. So while we are still driving the economies of the world because of the amount of debt we're issued, and that in turn is keeping the US economy moving forward, and in turn driving stock prices, there is that proverbial price we're going to pay at the end of the day. And right now the economy is moving forward, but in the future, with the amount of debt being issued in excess of $2 trillion per year now, somebody has to keep buying that debt. And so we'll be paying attention to who's buying that debt and how much debt the US can continue to comfortably issue before we run into some other challenges. On this slide, one thing you'll see that we're missing, because this is primarily the US versus the developed markets, is you'll notice that China is not on this chart. And that's even though we're under international here, that's primarily because China is still considered an emerging market. An emerging market has a couple components to it that keep you at emerging versus rising up to developed. And that's really around two things that China struggles with. One is average annual income per capita, meaning the average annual income per citizen. And at 1.4 billion-ish people, there are quite a few large percentage of Chinese that are under a poverty level. So that keeps them in the emerging market class, as well as what is defined as a reliable or trustworthy regulatory system when it comes to investing. And that is a bit of a struggle in China right now. In fact, so much so that the combination of China's economy and things going on right now, the Chinese stock market itself is still below 2007 peak. So 16 years ago, in dollar denominated terms, the Chinese stock market is still below 16 years ago. And if you look at the Hong Kong stock market, which has struggled just about ever since China took over Hong Kong a few years back, the Chinese stock or the Hong Kong stock market is back to 2015 levels because the economy as a whole there is struggling, and investors are seeking to either invest in Japan or the US market versus the Chinese market at the moment. On the next slide there, you'll see some of the fundamentals on how that they're described. In nominal GDP growth, the US is leading the pack right now, again, because of the money that we're spending. The earnings growth was up, nice 7%, not quite as nice as Italy there. Net margins were up a little bit below Canada. Our dividend growth rate was up a little over 6.6%. And then just like golf, you want to have the lowest score. So our score came in at 1.5, which again, if you look at the markets in total, because of the money invested here in the US, we're moving ahead. It is these reasons, though, with the euro that I explained earlier, the strings attached there, and the world monetizing US dollars. And I believe Aaron touched on it earlier with this allocation on small cap conversation. we've made a conscious effort for the past 8 years to keep the international market money, since around 2016, the allocation much lower than normal because the US was going to charge ahead and spend, and the other countries were going to be restricted. Again, a lot of European countries have better balance sheets because of those rules, but in turn, it prohibits their ability to quickly grow their economies at the expense that the US is paying, and thus their stocks. And as a quick reminder, about 40% of the S&P 500 company earnings comes from international markets. So you do have an exposure there to international markets by owning the S&P 500, which is a large component of our client holdings, versus going out and trying to pick individual countries that may or may not, and the chart shows, are not outperforming the US on an index basis. So in general, the US is doing better across the all boards because of the money we're spending at the moment. Next slide. So here is some of the forecasts from economists and Raymond James on in 24, they expect the US economy to continue growing. 2023 is about 2.5%. We think some more recent numbers that just came out in the beginning of the year, this is 12/31 data, is showing that we might be able to see somewhere around 2% plus growth. And if we do, that will outperform most other countries at the moment. On the center slide there, or chart, the US again has the real wage growth, and that helps drive consumer spending, and that helps drive the economy. And then on the far side there again, info or tech, as we know, the Magnificent Seven, those stocks have really been pulling up the indexes themselves and doing a great job. But again, as a whole, with US technology, US medical, US industrial, compared to all of the countries in whole, we are doing better, and that is showing up in the strong stock performance. I'm going to touch on energy. We've touched on a few different subsections here. So on the energy slide here, it's going to talk about on the left, we've all talked about oil production. And right now, OPEC has been working, well, since the 70s to control oil prices, but OPEC is trying to lower the output in combination with Russia. Russia's oil is free flowing more than we anticipated because of the restrictions of the war, but enough countries, including China, have no problem buying their oil. So Russia's pumping a fair amount of oil, so is OPEC. They're trying to reduce those numbers though, because they want a higher price, and the US producers are actually on a gentle rise there. And so we're able to eat into their production cuts, keeping oil at around $75 a barrel right now. Some aspects during the terrible Russia-Ukraine war going on right now, we're seeing oil at around $130 a barrel, but thankfully we're down around 75 right now. And with some thoughts that we might enter into a slight recession and thus less travel, et cetera, oil is coming down and might hover around the high 60s, low 70s for a little bit. And as we come out of this recession, Raymond James is forecasting that we'll be at around $85 a barrel come the end of 24. On the right-hand side, we continue to watch the rigs. They come out on a monthly basis with how many rigs are being used to produce oil. And it's kind of an ebb and flow. As the economy is getting stronger, you'll see more production come out. As the economy ebbs, we'll watch the rig count come on down due to a lack of demand and not worth the current oil prices. Again, staying in the energy sector here, the energy sector is trading at one of the largest discounts to the historical average, and that's for a couple of reasons. Right now, well, kind of three reasons. We have the higher cost of capital from the Fed raising rates. So anytime they want to go out and borrow money for investment projects, the cost of capital to do so does affect the earnings of the companies. The other reason that is occurring there is because there is a push and a trend for electric vehicles. There's a push and a trend. If you notice, if you go out looking at new cars, the fair market value, if you lease a car, or the used car price forecasts are actually coming quite down for the future, even though they're 3 years old, 5 years old, because the more and more car companies are pushing for electric. So the question is, what is the market availability for gasoline-driven cars going out 5 and plus 10 years? What is that? What is that market? Who are the buyers? And what does that look like with the EV push? So the question is, how long do you want to own oil companies if the market in general is going to be switching to EVs? So the growth rate for oil companies seems to be stymied. And if it is, they're going to trade at a discount, because when we buy stocks for our clients, it's about what do we see as the future, right now we see the future as being kind of stagnant for oil based on current regulatory environments. And until that changes or the electric vehicle mandates get pushed out 5 or 10 years, if that were to occur, these companies will continue to trade at a discount. That's why they have tons of free cash flow, though. The energy sector has a lot of cash flow. They have decent dividend rates. The challenge is going to be on the growth side as the market moves more to EV. And that leads to the outflows. More and more people, even though there's good companies, good cash flow, if you want to look 10 years out, though, the question is, do you want to own oil companies on a 10-year horizon? If once again, if the switch is to electric vehicles, we want to own more than is contained in the S&P 500, maybe a few good dividend stocks? How much do we want to invest in there? That's always a question. But right now, regulatory environments are slowing our taste for that at the moment. On the next slide, so brings us to volatility. We had some decent volatility this year with the unfortunate Israel-Palestine war going on in the late October there. The fear of Iran may be coming in. We are in an election year. We are going to most likely have some volatility due to that. At the same time, we might have a mild recession. So what comes to us, and Raymond James, an economist, is always thinking about what do we want to predict going forward. And 2023 was quite unusual because we had forecasts for the things we see here: mild recessions, inflation is going to remain high, it's going to be a negative year for markets, earnings are going to decline on a weaker GDP, Ukraine war is going to lead to oil, and any other number of surprises, which the unfortunate Israel-Palestine war and possibly bringing Iran into that end of October had us all nervous. And in the end, every single category came out markedly better than anyone was predicting, which then makes it tough as we go to 2024 slide. There's a series of forecasts there that will, thank you very much, have forecasts for a soft or no landing is what the market is pricing for the economy. Some people think a mild recession, and I want to spend just a few seconds on the recession. We had a mild recession, which is defined as 2 negative quarters or declining quarters of GDP in a row. We had that in 2022 as rates started to rise. But keep in mind that the economy has grown so fast coming out of COVID to a magnitude of 20–30%. That even if we have a 0.5% decline in GDP or some nominal decline quarter over quarter, we're coming off a much larger number and a much more robust economy. That is nothing for us to be overly concerned about because it'll muddle through, find its footing, and continue to grow. But if we end up in a -1 or -2% GDP, we'll be very, very focused on that. The Fed has put out their dot map suggesting there might be up to 6 rate cuts coming in 2024. Most people, including the stock market, think it's around 3 or 4 rate cuts. And so we're going to be obviously paying attention to the strength of the economy and the need for the Fed to lower rates, which right now the Fed is leaning towards a rate cut in March. But this week we have more GDP numbers coming out, we have more inflation numbers, and we had some strong consumer numbers. And so that information may push the Fed off another month or two. The consensus target for the S&P 500 is around 5,000. There's some Wall Street firms that are at 4,500. Some Wall Street firms are at 5,300, which is about 6–7% higher from here. The Raymond James thinks there's about 3% upside. So when we look at everything dialed in and what kind of year we might have, we think at the end it's going to be one of the more mild years as far as returns, but it's going to come with its fair aspects of volatility, mainly because of the election cycle that we're in. Earnings, the market thinks we're going to be at about 200, or the forecast for around $245 per share, which gets us up north of 5,000 on an earnings basis for the S&P 500. And Raymond James is forecasting something a little bit less, around the 225 mark. And so we'll see how it goes. And we have, not this week, but next week on Tuesday and Thursday, we have 6 of the 7 major technology companies reporting on Tuesday and Thursday. So that'll be a nice data point for us to try to get a flavor for how the year is going to work out. And then if the economy does slow, we're going to have an issue on oil prices. But oil prices most likely, because the economy is going to come out the other side, oil prices will start grinding back up towards that $85 target up there, in combination of OPEC and Russia being successful in trying to dial back some of the supply in conjunction with what the U.S. is actually increasing supply to earn some money. So we'll see how these play out. 23 was a wild swing and a miss because everything turned out more positive, and we'll take it. But right now, 24, we'll see how this election year and the volatility throughout the year plays into that. So from an investment perspective and an asset allocation, like we say, diversification wins because nobody knows where we're headed. Nobody knows what kind of tax law, monetary policy, or where things go geopolitically. But in the end, the only change that we really focus on is reducing the international markets for quite some time, and to a lesser extent, the small cap, mid cap relative to large cap growth and the large cap S&P 500. And that has worked, again, primarily to US tax policy, along with some of the tech stocks really having a great year last year and raising the entire market with it. But riding through the volatilities with the right balanced portfolio is how we all win. And you can see from here how the blended portfolios perform over time, even though various asset classes will perform better than others on any given year. It's just hard to predict. You'll notice that some asset classes that won last year fell all the way to the bottom the following year for one reason or another, and you simply can't predict that. So own quality companies, follow the tax laws and what governments are doing, and that's how we do our best. So with that, I'd like to turn it back over to Vanessa, and I think she's a little, she's going to touch on a little bit of tax related issues on 1099s and see if there's any questions.
Yeah, if you have any questions, feel free to type them in your Q&A section of your Zoom bar. We went a little longer today, so if we don't have any questions, we'll let you guys go. The one thing that we did want to bring up was regarding the 2023 1099 statements for your accounts. If you were a client of ours prior to June 1st, you had your money for part of the year at Pershing and part of the year at Raymond James. So for any accounts that a 1099 will be sent, you will have two 1099s for tax year 2023. We'll be able to very easily help you with the Raymond James 1099s. The Pershing 1099s, if you were used to getting those emailed, you will now be able to not only get them via email, we'll send instructions on how to do that, but they will also, because of our move and because of Securion's sale to Cetera, they will automatically be mailed out to you. So we don't expect them to come until early March, mid-March, but we just wanted to give you some heads up to understand that you will be getting 1099s from both firms for 2023. The first half of the year from your Pershing accounts and the second half of the year from your Raymond James account. So any questions on that, don't hesitate to reach out to us. We appreciate your time this afternoon, and we'll be in touch in the next quarter for another town hall. Thank you all.